What's going on, guys? My name is Arjun and welcome back to my channel. Now, I've made my fair share of mistakes in my journey to becoming a better investor. And I've seen a lot of new beginning investors make these same mistakes. So I wanted to go over 5 of the most common mistakes that beginning investors make and give you guys some tips that I learned in my journey to help overcome these mistakes. The first mistake that I see beginning investors make is buying the trendy stock of the week. It's so easy today to go online and see dozens of people talking on social media about how much money they've made in XYZ company for that week. But it's important to remember that in a lot of these cases, as quickly as they go up, these stocks can come right back down. And the majority of successful investors are long-term investors. While it's possible you could make money buying and selling the trendy stock, you would really have to be good at finding the top and finding the bottom and being able to time yourself in and out of the market, which is almost impossible. So instead, this is what I would do. The first thing is make sure that I do my homework on a company. I want to do my research, find out what the company does, how they make money, how they plan to make more money in the future, and really give myself a reason for making that investment. Without that, it's going to be really difficult for me to ride the up and down movement of the stock market. So once I've done my homework, I'm going to buy the stocks that I like and not just the trendy stock of the week. And finally, if you do decide that you like the trendy stock, not just because you're riding the trend, but because you actually like the company, because you've done the homework, it's going to make it easier for you not to succumb to your emotions when the stock goes up and down like crazy, and instead you'll be able to ride through them, perhaps buy more when the stock goes down. The second mistake that I see beginning investors make is panicking and selling. When you see stocks go down, your immediate reaction is, oh my God, this is the end. I need to get out of the stock market or else I'll lose all my money. When in reality, this is actually the complete opposite reaction you want to be having. Emotions are the most challenging thing to deal with in investing. And as I said many times before, emotions are the #1 enemy of investors. So, what you should do instead in this situation. You've invested in the company because you like it and you believe that it'll do well over the long term. So, you should think of the sell-off or the dip as a sale. Think of this like Black Friday. You have an opportunity to buy more at a lower price. You should be excited about that and be ready to buy when that comes. And when you are ready to buy, don't buy all at once. Be patient when you're buying and buy a little bit at a time, because quite often these dips happen over many days. And it's not just one big drop. We may see a stock go down multiple days in a row. The third mistake that I see beginning investors make is trying to time the market. Timing the market is nearly impossible. Even the most successful investors will tell you that timing the market is a fool's game. So what I would do instead in this situation is what's called dollar cost averaging. I would buy my stock at consistent intervals over a period of time. And this will give me the best price because I'll be able to get some of the up days and some of the down days in the stock and get the best price for my stock rather than trying to just wait and find the bottom, because chances are I'm going to miss it and end up buying at a higher price anyways. An important point here is be patient. To help you be patient when dollar cost averaging, have a price in mind. Don't go chase the stock price. Have a price in mind that you'd like to buy it at, because in many cases, the stock will come back to your price and sometimes even lower. Remember that time in the market is greater than trying to time the market. The fourth mistake that I see a lot of beginning investors make is holding on to their losers and selling their winners. There are a lot of people who will not be willing to cut their loss, and instead they'll try to subsidize their loss by selling their winners. The first thing I would do is establish a core part of your portfolio. You're not really going to touch this except to add more money to it when the stocks come down, These are positions that you believe over the next 5, 10, 15 years are going to do tremendously well. You have these core positions in your portfolio. These can be index funds, mutual funds, individual stocks, whatever you would like. And you're going to keep adding to that over time. That is the part of your portfolio that's going to consistently grow for you. The second thing I would do to avoid this mistake is accept that losses are a part of investing and let go of your losers. Sometimes you just got into the stock at the wrong time, or you made the wrong decision about a stock, and that is just a losing position for you. So take the loss and move on. Move that money into your winning positions. Don't let yourself get emotionally attached to a position. The final mistake that I see a lot of beginning investors make is not taking any profits. A good example of this is GameStop, that we saw go from $17 to more than $400 earlier this year. That's well over a 2,000% increase. There are many people who really love GameStop, but they weren't willing to sell any and take some profits when the stock was up. So if you had sold at 300, let's say, then you would have been able to buy more of the stock down when it came down to 100 or 90 a couple of days later. It's always important that you're willing to take some profits, to take some money off the table. Remember that your gain in your portfolio is only on paper until you sell the stock. Here's what I would do to avoid this mistake. First thing is have a target return in mind for a position. Whether that's 50%, 25%, 100%, doesn't matter, but have a target return in mind for that position, and when it reaches that target, take a portion of your profits. Don't take it all, but just take some of it off the table so that way you have cash to buy when the stock comes back down. By taking profits, this also helps you to avoid panicking and selling the stock because you now have some cash that you've made from that position that you can reinvest. So now I just want to recap what the 5 most common mistakes that I have seen are. First is buying the trendy stock and not doing your research. Second is panicking and selling when you see stocks going down. The third is trying to time the market, meaning trying to find the exact bottom and trying to find the exact top, and not remembering that it's more important to have time in the market than trying to time the market. The fourth is holding on to your losers and subsidizing them by selling your winners. In the end, all you're left with is a portfolio of losing stocks. And the final mistake is not taking profits along the way. Until you take profits in your portfolio, it's all just a paper gain. I have made many of these mistakes, and hopefully the information in this video will help you guys to overcome these mistakes and avoid them yourself. Thank you guys for watching this, and if you enjoyed it and want to learn more about business and investing, comment, like, and subscribe to my channel, and let's head on over to the next video.